For investors, volatile markets may be challenging. It may be challenging to decide where to invest in order to maximize profits and avoid dangers given the market's rapid changeability. In this video, we will be exploring a variety of investment strategies for volatile markets that you can use to make the most of your investments. Diversify portfolios. Diversification is one of the finest tactics for a profitable investing portfolio. This implies that you have to diversify your assets widely, taking into account factors such as risk tolerance, industry, location, and more. For instance, if you just invested in equities, the market would fall and the stocks might plummet. Your risk is distributed over a variety of asset classes if you diversify with a mixture of stocks, bonds, cash, and maybe even commodities like gold. As a result, your experience during a collapse may be less turbulent. Additionally, if one specific industry faces a slump, having a broad portfolio might provide you flexibility. Because of this, many wise investors allocate less than 20 to 30% of their portfolio to a single industry or asset class. Dollar cost averaging. Dollar cost averaging, DCA, is yet another superb method for making money with investments. A set sum of money is invested in the same investment over a long period of time by an investor using DCA. Due to the fact that only a tiny amount of your purchase will be impacted by any one significant fall or surge in market price, this reduces the risk associated with market volatility. This may eventually lower the investor's purchasing price, while also increasing your wealth over time. Growth stocks. Growth companies are precisely those that may achieve above-average increases over extended periods of time while searching for new investments. This is due to the fact that they could be a part of a fast-increasing industry or that they might make up a significant section of a developing economic area. Investors who are seeking for growth stocks should investigate the fundamentals of the firm, including its revenue growth, earnings history, and possible future catalysts. Consider these variables as well as the possibility of decreased growth rates in certain industries over extended periods. Hedging strategies. Hedging is the process of investing in securities that may typically go in the opposite direction from the one you are looking to gain. By selling a stock that is in a decline and concurrently purchasing one that is in an uptrend, one might be playing the market from both sides. It could also include investing in futures markets, currency markets, or other derivatives products, as well as buying puts and calls. Whatever the vehicle, hedging is primarily employed to gain when markets move in the opposite direction of one's investment and to safeguard against losses. Investors should use caution, however, since improper management of these markets might result in losses. Consider investing in bonds. Another asset type to think about for investors is bonds. When a business or the government issues a bond, they are given a loan with a fixed interest rate for a certain period of time. That indicates that, at bond maturity, investors will receive fixed income from the bonds for the life of the loan at the set rate. Since the investor is the guarantee of the loan inside the bond, which sometimes offers high rates of return, convertible bonds may be the ones that appeal to investors the most. Utilize defensive strategies. Losses might occur while investing, which is a drawback. The wisest course of action for investors is to use defensive measures when losses are large. These might include dollar cost averaging, safeguards such investments in collateralized debt, or actively liquidating assets before significant losses could materialize. Investors may also use stops, other safety measures including margin calls, and restrictions on transaction size actions. Hedging is another option since it entails taking a loss on one side of an investment while simultaneously trying to make a profit on the other in order to gradually recoup the initial investment over time. Invest in long-term assets. Investors often see long-term assets like real estate, bonds, government securities, precious metals, and even exchange-traded funds, ETFs, as safer investment options. These investments often take longer to pay off, sell long-term, but they might be quite profitable in the long run, particularly during times of moderate to high inflation. Investors may purchase real estate at a reduced price and keep it for future profit. For instance, just be careful not to purchase more than you can afford, and be aware of the risks involved when looking for assets other than stocks. Increase cash reserves. Increasing your cash reserve is a fantastic way to secure your assets over time. This doesn't necessarily mean having more money in your checking account. It just means having a variety of assets that you can quickly convert to cash if necessary. With a cash reserve, you may protect yourself not just from market volatility, but also from improbable events like sickness or financial hardship. The additional benefit is that you have assets that you can rapidly exit if the market cycles downward, enabling you to invest at cheaper prices when the markets turn in your favor. Invest in high dividend yielding stocks. Stocks with high dividend yields are always appealing to investors, particularly those who have little or no taste for risk. A corporation has the right to offer us a predetermined high rate of return with these stocks. While some dividends may be reinvested to provide more steady growth over time, others are paid out on a monthly or quarterly basis and can help investors make immediate progress toward their financial objectives. Some businesses even provide shareholders who keep making investments in their business slightly greater rates. Even during market downturns, this may help deliver steady profits. Take advantage of market opportunities. Many investors may be persuaded to seize favorable investing opportunities if given the opportunity. Being proactive in looking for excellent opportunities might pay off in the long term, depending on which markets may meet your aims and risk. Foreign exchange markets, stock exchanges, futures, or even cryptocurrency markets. To assist them surpass the averages, many elite traders design methods specific to particular markets. Making use of the programs offered to investors may also aid in finding different tools and tactics that many seasoned investors use while making decisions. Be willing to adjust your portfolio often. It is beneficial to keep an eye out for shifting trends in the markets you are investing in since the world is continuously changing. Analyzing macroeconomic trends and market movements might help you spot fresh possibilities for profit or protect you from future losses. Keeping a watch on news sources, investment forums, and trend spotters might be helpful in gaining an advantage over the market. When making transactions, keep in mind the taxes and fees related to extracurricular choices, and take those costs into consideration when calculating your earnings or losses. Overall, being abreast of market movements, making required portfolio adjustments, and exercising caution before risking a large amount of money on a single transaction are the best ways to keep on top of the markets. This is it for today's video. What do you think of our video? Let us know in the comment section below. Don't forget to like and subscribe to the Financial Tech channel for more future updates. Thanks for watching.